All right. Well, this is the big one. It's going to be market fit. I was originally going to, sorry, not market fit, fundraising. I was originally going to split these into several different parts, three or four, three or four, or I don't know. Doesn't matter how I show three or four. Anyway, but I decided to kind of put them into one, just because that way it can kind of flow more continuously, since it's probably not going to be a ridiculously long video anyway, and it's just better to kind of have that more connected explanation. So just to kind of, let's put the title on here: fundraising. This is feedback number 9, I believe. But let's kind of start, walking through it. So obviously, as all of you know, in total, what we're looking to raise is 5 million, right? That's the target. That doesn't really change as far as fundraising, but what does change is basically instead of doing this as one step, or what's been suggested to change it. And I know I just I know I kind of phrase some of this as it's like a done deal. That's just because it's easier to explain that way instead of constantly phrasing in like what was suggested, blah blah blah. It's just that, but like I really want to hear feedback. It's still something I really want to discuss, but just phrasing anyway. So in basically in one step, that's what we were doing until now. And the suggestion is basically instead of doing it as one part, well, it is still kind of one pre-seed raise, but kind of split it into phases. So do it in a as a kind of a phase thing. So what that would mean, I'll first kind of start mentioning the kind of split of the phases that was suggested, and then kind of walk through how we would actually do it for ourselves in a more specific fashion. But and kind of explain them what they would mean. But essentially, by it being phased, it's really okay. So what are kind of the phases for us, just generally for fundraising, right? So firstly there's for market fit, right? That's so the first step is proving market fit. Now, once we've proven market fit, then there are two sides to what we're doing, or there it's actually one. It's the brokerage, but we have the education, which you can start doing without the brokerage license, and then we have the brokerage, which we need kind of more money for. So we can split them up when it comes to this. So there's for education. Then there is for the brokerage. And once we have the brokerage license, we have the education, we're kind of operating within the EU, then any scale, any funding, fundraising after that will be for scaling, or I guess expansion, right? So that would be expanding to the UK, and then afterwards would be the US or India based on the education metrics, et cetera, et cetera. So that's basically kind of the 4 general stages of fundraising that we would kind of be looking at, because those are kind of the three steps, right? First, just show market fit in any way you can. Next one is there's a lot to expand on with education as far with the funding. So we will have we'll be able to increase the amount of stuff that's going out by building out a bigger a fuller team or proper team for actually the educational courses. We will be like update it to include video and audio instead of just a text like the explanations have now, et cetera, et cetera. So that that can cover some funding. Brokerage, obvious brokerage license is basically the big one there, and then expansion. That's basically a lot of the stuff to do after to UK, India, stuff like that. So these are kind of those 4 phases. Now, what do those I guess represent for us? Like, what does it mean on how? I don't like writing in that direction. Let me just do it normally. How we'll raise, basically. And a way to kind of look at it as kind of a timeline, I guess. Let me just write it in timeline for us would be kind of a few parts. And I guess it's somewhat timeless. So I'm not going to actually include like exact dates to aim for, but I'm going to talk about kind of roughly what we're thinking, or what I'm thinking as far as that timeline in there as well. Well, the first step, since the first step in there is market fit, would be raise something for market fit. Now, what would this be? Let's just to basically market. I can't. No, I'm just gonna get rid of that and write that again, just because it looks super messy. Market fit. So let me just zoom in so it's a little bit easier for you to see. So when it comes to market fit, How do we prove that? We talked about that in some of the previous parts, and there's clearly a benefit to having some funding to do that, as opposed to doing it without any funding, right? When you look at startups and getting users and all that, it's a lot easier to show whether there's interest or not if we have some money to kind of play with, to spend on marketing, to spend on better ways we can do acquisition or growth of the actual community. So there's clear benefit to having some money there. So that's why we can fund. That's why kind of that first stage of market fit includes fundraising. And the way we would do that is basically we would start with angels. So in general, this is kind of that start with angels, and how much we could kind of be looking for there. Would I don't know, like this one is quite variable because if we have more money, it's easier to kind of get past that stage of proving market fit. But we don't want to. There's no super specific target here as far as how much money this can cost. Like it's not a brokerage license where we know exactly how much all that will end up costing us. So I'm going to kind of put in kind of a rough target here of mid six figures, because at the end of the day, let me actually, I just noticed this. This is not very convenient. I'm just going to move this below so I can continue writing. So how we'll raise. So this would be mid six figs, right? So that's roughly how much we'd be kind of looking to get at this stage. Because at the end of the day, all of this is going to that 5 million. That's what we need to do the entire thing up to the brokerage. So it doesn't include the expansion. So that's what we need the 5 million for, basically. Let me just put it like this. That's what the 5 million is for, to fully do this. So to fully do that. So because of that, what that means is, all of these kind of that timeline thing is we're kind of going to add up to those six figures. Sorry, not six figures. That 5 million is just what we kind of roughly need there. Then after market fit, that kind of market fit test, there's this kind of a continue, or I guess somewhat of an optional step, but that I think would be really good for us, especially since we did have YC. Some from YC reach out, ask us to apply. We have some recommendations in our YC applications and etc. So that would generally be, kind of a really good follow up to go through and have that support. So I'm just going to kind of put that YC there. Now their standard deal is also about mid six figures, so we can kind of use that to go further in the education. We can use that to, if we were like, oh, we want to get a better, like a bigger size of community, it will basically, just to kind of simplify, so the market fit, that money is just to get us through, just help us show our market fit much faster, because we can expend capital to save time. YC, they have a lot of assistance as far as they have a network. They help you actually understand raising stuff like that. They're quite useful as well for having familiarity with okay, what's a proven, what's enough of a kind of numbers game showcase so we can prove market fit. So we can then spend the YC money on grow, investing more in the community. We can be like, oh, we're actually gonna start, we're going to start expanding the education team earlier on so we can have more education to show. Like there's different options there that we can be looking at as far as what we'll do with the YC money, depending on how that market fit part goes and what kind of feedback we get in YC. And then lastly, after that, the last step is the kind of rest of it, because it's kind of the mix, brokerage. And now here comes the thing I don't know how to write. Nope. Oh, that's close enough, actually. So I'll take it. And education. So the reason I wouldn't really, I wouldn't really raise separately for the brokerage and for the education is because education will keep getting us users. And that is a way to reduce our burn rate that we talked about, with the adjusted revenue plans, which will kind of allow us to basically use the education to not have as big of a burn rate while we are having the brokerage. Meanwhile, it continues to test and improve the education, build awareness, build community, get more numbers, blah, 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 continue with that scaling and, improve the education while we also finish off the brokerage. So splitting them up wouldn't really make sense because education on its own is not something that will generate enough revenue based on how we're planning it to cover our operating costs at any point. And down the line, once the brokerage is fully running, it would make no revenue or minimal revenue, if anything, because we really want the education to really scale for the number of people that we get into the brokerage as possible. So if we start, if we keep making money off the education and that ends up being the critical part, then that's just hurting how many people come into the brokerage. And the brokerage has far more, potential for how much money it can make per user than how much we can make from the education, which is why it makes sense to kind of focus on that brokerage as that revenue source. And as such, education will, until the brokerage launch, is kind of that reducing burn rate. So it doesn't make sense to, to raise for them separately. And that's why I think it's best to kind of do that next step of basically doing both. And there, it's basically kind of the rest of our pre-seed, right? That's the rest of our pre-seed, because technically to be seed, we need the product launched fully. And so a brokerage license, technically, we can't say that that's where we are, but that's basically the rest of it. So pre-seed, the rest of pre-seed, whatever you want to call it. Now, how are we actually going to raise each of these parts? I'm going to pick a different color just to kind of differentiate it. Well, one of the things I haven't, when we talked about safes, they're easy way to get the money in faster. We can issue shares later, blah, blah, blah. It's just a little bit more, it's not a little bit, it's a lot more efficient than doing a full proper standard like Series A priced round with board seats being given away and everything. So there's a clear benefit to doing just safes. But one thing that we haven't really considered with safes, the way we've been approaching things now, and I think based off of some of the discussions I had, it would be quite good to change, and I think we're going to change it, is use safes as, you can have different ones. They allow for continuous raising. And we can have, so what we would do is we would, for the market fit part, we would have a 20% discounted safe. And just a side note, it would ignore YC deal, ignores YC deal. Now, the reason it would ignore the YC deal is because YC has that 7% at a really shitty valuation. So we don't want to get that kicked in through the YC, but based on the valuation at the pre-seed state. So that's just kind of a side note of why we'll have to have it ignore the YC deal, because we're taking the YC deal in order to better position ourselves, right? Like the YC deal isn't the actual, like we're not accepting it because of the money. It's not a fair valuation to kind of go by. So by having that 20% discounted safe, we so it would be uncapped, 20% discounted, uncapped, and that's kind of the important part here. So what that means is there's no basically capital limit that we are as far as our valuation, essentially. So what uncapped means is that there's no valuation that we're putting in. As such, the way this works, since 20% discounted, what it means is that they'll just get a discount on our valuation, and then based off of that, they'll get the money, get their, get the number of shares. So let's say someone has that's super simple. A company for $10,000. Actually, let me just write it out for you here in a little side note. So let's say someone has a valuation of 10, let's say million, just to keep it simple, right? And somebody wants to invest. So invest 1 million. And just to side note, this is post money. So this is at the end of this, the valuation. Well, the thing is, if they have a 20% discounted, so 20% discount, what that means is that instead of getting, let's say they have 100 shares, just to keep it 100 shares, just to keep it simple. What a 20% discount means is that in the 10 million for one, they would get 10 shares, right? So standard, so the discount. So with no discount, they get 10 shares. That's it. So they have 10%. So they have 10% of the company. But if there's a 20% discount, then a 10 million post money, well, they get their shares as if 8 mil valuation. Instead of having the 10 mil, they act as 10. So 20% discount off that post money valuation. And then of that, they get 1 million. So that's 1/8. And then they get 1/8 of 100. So they 1/8 of 100 shares instead of, well, basically, actually, let's just write both of these as a fraction instead of 1/10 of 100 shares. So you can see how that ends up benefiting the investor. But you can have the valuation set later, which is kind of the big benefit for us, that we don't have to convince someone right away of like, this is why we're worth as much as we think we are. We can just be like, we'll give you this discount. You clearly like what we're doing, otherwise we wouldn't be investing. And we'll show you by August or at some point like that why we think we're worth what we are. We don't even have to really mention it, but they get the good deal based off the discount being there. Now, continuation. So that's YC. Well, YC doesn't really negotiate on their deals. It's pretty standard. So we just get, so it's standard deal. What standard? Let's do standard YC deal, which has an uncapped safe and a capped safe, and so pretty kind of the way it works there. And then in the kind of final part, which we're calling pre-seed, it would just be using standard safes with a cap. So that means that with a valuation, and that would then kick in a valuation for the uncapped safes from the market fits part and the uncapped safe from the YC part. The thing is, YC also has the capped safe, which is why we need to make sure that the deal with angels ignores that the deal with angels ignores the YC deal, because that would just be dumb. But as long as because the first part, because basically, well, just to contextualize, YC there's a capped safe you get, and then there's an uncapped safe you get. They kind of split it into two. So that's why I'm just kind of mentioning that. So that's basically how we would then go about raising it. And I think that basically covers everything. So it's been relatively shorter than I somewhat expected. But just as a quick summary, so for the fundraising, we still want the 5 million that we talked about. That's we have all the data we need to know that that's kind of how much we need. Splitting it into a way to think about kind of splitting the entire thing is basically into phases of market fit, which is just having kind of really solid data to be like, this is 100% something that people care about, which I think we do because of all the stuff that I've done with the education before. But that's something that we specifically have to show with FAIR. So just having that data again for FAIR is kind of what we're doing there. Then the education and brokerage, that's basically expand education, expand brokerage, or actually get our fucking brokerage, because the brokerage license. And then the next phase is expansion. So what we're doing with the 5 mil is we're doing kind of the 3 stages there. And how we'll go about raising it is we'll kind of split it across several stages, because that's what safes allow you to do. You don't have to raise everything as a single price round. So we'll have the first one be market fit, which will be about 6 figures that we're aiming for from angel investors through 20% discounted uncapped safe. And then we would do the YC deal. If we got in, that's pretty standard. They would kind of help us with a lot. They're very much. They also have the demo day in end of August. If we were, that we would get to do, and that's basically when we would do the last part, which would be raising the rest of the money for a mix of the brokerage and education, which would be kind of close off our pre-seed priced round, and that will be done through safes with evaluation, so capped safes. So that kind of covers everything. Would really like to hear what you guys think, and that will be kind of the last feedback update video for this week. If we, get more updates and feedback in the future, we'll definitely be going through that. But this was kind of the big one for tomorrow's meeting. So just make sure to watch this. If you don't understand it, ask questions, discuss it. This is, I think, the biggest feedback one outside of the focus on market fit. So really, if there's anything about this that's confusing, you don't understand, ask about it. Let's discuss it tomorrow. Send questions right away in Slack so I can kind of discuss it. If you have thoughts, disagree with it, agree with it, whatever, make sure to put it in the Slack thread, and then you can mention it in the company sync tomorrow. If you have questions you don't want to ask in the actual channel, you can just DM me. That's fine. But yeah, thank you very much. Looking forward to your opinions, thoughts, and questions, and then see you on a call in the meeting tomorrow. Bye.